Welcome to Crescat's Market Call, featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and CEO. Before we get started, please read through our important disclosures being shown now. These and additional disclosures regarding the risks involved in the type of investments we will be discussing, as well as the fund's performance, can be found on Crescat's YouTube channel and on our website. The type of investments discussed on these videos can carry significant risks, including risk of loss. These videos are intended to be general discussions of macro investment themes, the mining industry, and news with respect to the companies in our activist metals portfolio, and are not intended to be investment advice or an offer of investment advice or services. Crescat's managed funds only accept accredited investors, and the discussion in these videos has been prepared with that level of audience sophistication in mind. Any forward-looking statements may or may not come to fruition. If you enjoy our videos, please click on the like button and make sure you subscribe to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on X for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Merrick Iwahashi. His contact information is on the screen and can also be found on our website at crescat.net.
All right, everyone. So today it's going to be just myself doing the presentation, and then Quinton has recorded his presentation. Appreciate everybody coming here to watch. Let's get started with a few charts that I put together. By the way, if you have not had the time yet, and maybe I'm biased to ask you to do so, but we have recently written a letter about our views in particularly the mining space. And if you have not had the chance to read it yet, this presentation is going to be mostly about that and some other fresh views about the markets. But I would love to also say that that's also a recently published piece that we have worked on over the last few weeks. And it's really about how mining comes first. We've been laying the foundation. We've been building a home without really laying the foundation of it. And to me, this is how critically important the mining industry really is to the world and to function the global economy. And these letters are a real intellectual process of trying to not only research as much as possible about a certain subject, but refreshing your views and learning more than anything about this industry more and more. And this time, what I learned is one thing that to me is almost as important as investing in the mining industry. And it's a bit of a doom and gloom sort of view about the world, but it scares me to see how the industry of mining has completely lost its value and relevance in markets. Although when you think about how it is embedded in our society in so many ways that people are not aware of, differently than other industries. We cannot live without mining. And so to me, it's almost like we're turning from initially when I got involved into investing in mining industries, in this mining industry, first part of that thesis was because of hard assets and how we thought the market from an underlying metal prices standpoint would improve drastically, therefore increasing the margins of these companies and how these companies had an outstanding value proposition to invest. Now, the more I learn about this potential opportunity is that I believe that we're getting into a point where it's now turning from a value proposition to an actual necessity. We have to be spending capital almost in this space to secure metals. Otherwise, things are going to get very dangerous from a society standpoint. The chart that you're looking at the screen is something that I was aware of, but I wanted to measure better and understand what has been the shift in terms of America's dependence on metal imports. We know for a fact that the mining industry, not only globally, but in the US, has diminished to a point that it almost looks like a margin error. And in my view, one of the main aspects of that change has to do with the fact that we've become almost completely reliant on imports of metals. The screen here, as you can see in the chart, is broken down into different types of metals, and it shows all the way to the 1970s to the decade of the 2020s. So it's broken down into decades. How much of those different metals we imported, and as you can see, the numbers in all of them have been increasing. So we've been seeing a gradual increase of metal imports for many reasons, and this includes refined and processing capacity and all sorts of different aspects of the metals and mining industry, of which China has taken over in a huge way in terms of the refining and smelter capacity. But that puts into an important situation of how we're seeing these companies that hold assets in this industry are becoming very strategic for investors at this point. And so if we go to the next chart, you can see in a separate way of a chart that I've used in the past that really caused me to do the research of the prior chart, really is the fact that the CAPEX of the overall mining industry used to represent close to 17% of nominal GDP. And today we're only 0.3%. And a lot of people that look at this chart, they tend to say that it has to do with efficiency and all sorts of things. And it's not. The reason for it, the more you research about it, is the fact that we're importing more metals. And basically with, just like we have manufactured away our economy, we've had also mined away or this industry to rely on supposedly strategic partners like China that will provide us the metals and that we need. And I think the more you get involved into trying to acquire private companies and other things, what you learn about it is that the Chinese model of capital, and the more you sort of compete with them in terms of investments, you learn that the net present value of most mining companies is completely meaningless to those parties. No, they approach things from a standpoint of securing metals, and we here in the U.S. and other parts of the world have this tendency of looking at things from a value standpoint, and unfortunately, it's very difficult to compete with parties that are willing to throw almost any level of capital just to acquire something with the thesis of necessity rather than the value proposition, as I said earlier. And it's a lot of these conversations about innovation, about religion, about a lot of times get involved into who comes first, the chicken or the egg. It's sort of that dilemma question that a lot of folks tend to discuss. But this is not one of those dilemmas. Mining has to come first. Otherwise, you can't really build any innovative economy. You can't build robots. All of us would love to have robots adding to the economy. Elon Musk has been talking about potentially adding, the robots to help us more efficiently to live our lives and build things, and also in automation and. But just a simple research on that. If he said we're going to have about even more than what we have in units of cars in the world today. If you just do the back of the envelope calculation on that, you're going to figure out that that alone would consume about 20% it would increase the global electricity demand by about 20%. So these are calculations that are a little bit scary in many fronts. Let's go to the next chart. Now, the next chart is something that bothered me a bit. So you're looking at the white bars. It's a busy chart. So it's looking at U.S., not global, U.S. electricity consumption per decade. So you're looking at growth on the other hand. So those are growth rates per decade. And that's using an annual growth, average annual growth. And so what you can see here, we've been in a declining growth trend since the 1900s. Now we had the Industrial Revolution, then we had the beginning of 1900s, and later on in 1800s, 1900s, and then you had some moments of electrification that intensified in the early part of the century. Then we had World War I, and after that, the Roaring '20s was a huge part of the electricity consumption at that time. Then we had a big decline, or at least of rates. Right, the rate went from close to approaching 11% all the way down to less than 6%. So it's half of the growth of the prior decade in 1930s because of the Great Depression. And then we had the war in Second World War II in the 40s. And that kind of went on. As you can see in this chart, there's so many different, I'm not going to go on to each one of those decades. But recently we've seen the estimates of McKinsey, which has been, why did I use McKinsey? Not because, I endorse them or anything along those lines. It's just because actually they were the most credible institution that had the largest estimates for electricity consumption. And after reading their reports and trying to understand where they're coming from with those estimates, I even think that they're extremely off on their estimates. I would suspect that we may see a 50% growth of electricity consumption in the next 5 years. And I'll share a chart with you in a minute here, so you can have a sense of that. But I try to list all the things that are happening today that are causing this electricity consumption issue. You have the data center expansion, you have electrification in transportation with electrical cars, we have the grid modernization. We're going to be essentially having to do a bunch of changes in infrastructure. We're seeing the industrial revamp aspect, the onshoring trends. We're seeing homes become more electrified. And lastly, we're also seeing the cryptocurrency mining, which, should not be ignored as well. But I suspect that those blue lines are actually being very conservative. I think particularly the 2030s, of course, we're talking estimates. I suspect it's going to be even more of a growth rate than what's presented in this chart. Let's go to the next slide. And the next slide is back of an envelope calculation by a person that was actually shared this chart by Elon Musk. And it's and I thought was he was basically making a point of how massive, use the word massive, the consumption of power is likely to be just coming from AI alone. And I think there's two important takeaways of this chart. Number one, we're going to be adding an equivalent of the U.S. economy in the next 5 years, looking at this chart, and to the global demand of electricity. Number two, notice China. China would, just has become the manufacturing plant of the global economy. You can notice that the actual data is been in a growth rate that is more accelerated in the U.S. And the main reason for this, in my view, is because of exactly of manufacturing. And if we're going to see onshoring, on that alone, just on those bases, you would expect that the growth rate is going to be drastically higher. I'm very, very afraid that we're about to see a real black swan event in electricity. Electricity shortage is what I'm referring to in the next 3 to 5 years. I think that's one of the biggest unknown risks in the market right now. And if that ever happens, I think it's gonna. Sometimes that's what it takes. It's that type of crisis in society that creates the need and for us to see big changes and human ingenuity to come up with new bold ideas to fix those issues. And I think it's what it's going to take here. And the more conversations we have internally and with investors and friends, and my understanding of this is that consultants, in my view, are very off. And this is why it's a black swan event. If it wasn't, this is why it's likely to be a black swan event. It's because consultants, even really smart people, I'm not trying to say they're not intelligent of where they come from with their views. I think if you read their reports, are missing a lot of very critical aspects of onshoring and artificial intelligence in a huge way, and potentially could be very off in their growth rates. And that's exactly when markets get surprised by a new thing. It's exactly what the issue is. I would break down the opportunity almost in 3 parts from an investment standpoint. You have the energy source. You can have a lot of discussions of what would be used to power the world or the US in the next, again, a lot of people look at this chart and they say nuclear is the answer. Nuclear is the answer most likely for maybe 10, 15 years from now. We're talking 5 years. If you look at this chart, that's the type of growth we're likely to see. We have to be thinking about this now. What's the commodity that could really, or the energy source that can really help us in the next few years. The things that come to mind are a few things. Solar is the one of the fastest growth energy sources in the U.S. specifically, will likely play a big role into growth and supporting some of those 5 years. But we need something even more reliable than solar. That may be a solution for houses and others, but data centers require way too much electricity to be able to consume solar, for instance. But natural gas is probably your answer. Natural gas is currently about 40% of the energy source for electricity in the U.S. Wouldn't shock me at all if you see an increase maybe from 40 to 60 or something along those lines. So that's one bucket. It's the energy source. The discussions and investments that will be coming from that bucket alone are huge discussions. Number two is the infrastructure, of which I would say that energy is the first bucket I mentioned. Is certainly has enough people discussing and thinking about it and considering different ideas. The nuclear community, the solar community, you have the coal community, you have the natural gas community. All these people are thinking about different ideas on how to approach this issue. Regarding the infrastructure, we're waking up, right? We're definitely talking about infrastructure more and more. Certainly the grid, the aging of the grid infrastructure in the U.S. is a big discussion. Can we have enough capacity to allow these things to happen? That's where I come from, the view that we're likely to see a black swan event in terms of electricity shortage in the next 3 years or so. But the third, and that's a fascinating discussion too. The third bucket to me is the one that often gets ignored, and that's mining. How do we get the materials to do all these things? How do we get the materials to build the data centers and the homes and the grid and all that? You start looking for consultants, McKinsey and all, S&P Global and all the folks that I respect. By no means I'm trying to be disrespectful to their work, but what you find in their research is that none of them talk about what's going to be required in terms of capital in the next 5 years, even for us to get the mining industry in a better shape. One association of engineers have thrown a number of about $1.5 trillion that needs to be spent in the next 5 years to secure the necessary metals that we're going to need for all this infrastructure. Okay, let's do this calculation for a minute. $1.5 trillion of CAPEX over the next 5 years. All right. Well, how much is the overall industry today in terms of market value? Well, it's about $2 trillion. So you're talking that just on CAPEX alone, assuming those engineers are correct, which I think, just from experience, I suspect that we're very far from that actual number. It could be double and triple that amount very easily, given how much it costs for us to deploy things and the fact that we don't have any major development coming into becoming a producing mine anytime soon. Well, those questions are huge. In my view, that's the big elephant in the room that nobody is really talking about. Again, I'm going to repeat a phrase I said at the very beginning. In my view, mining comes first, not last. All right, let's go to the next chart. On the next chart, we're seeing what's happening across the world. We hear all the time trade agreements are improving and not. You have this whole roller coaster of emotions regarding where we are in terms of agreements between U.S. and China and other countries. But one thing has never been told to folks out there is the fact that China has been importing copper and other metals like there's no tomorrow. Yes, we knew that they've been stacking on metals before. We know they've been buying gold and been buying copper. But notice this is the highest number in history that has been reported over the last 2 months. Well, that needs to catch your attention, at least. I mean, it catches my attention. And so clearly, some of these countries are starting to see the need, almost desperately, in what the way it looked like, of importing metals, and copper is in the forefront of that as well. Let's go to the next chart. Now, what I said about the $1.5 trillion and the CAPEX required, and you only have $2 trillion of overall market cap for the mining industry, I would say keep in mind the fact that the mining industry as a percentage of global equities is today about 1%. And back in the 60s and 70s used to be about 11%, so 10 times more. I suspect that this is the type of thing that it's a structural problem that turns into an opportunity. And it's, to me, we cannot be living in a world where, in my view, that we continue to see this declining rate of the relevance of the mining industry relative to global equities and the global economy overall. And if we're going to continue to innovate and grow, very likely we're going to have to be doing this in combination with more capital flows into the mining industry. And so this yellow bar, in my view, is poised to rise. And those are my 2 cents on the macro environment over the next decade or so. Let's go to the next chart. And another thing is how many people, and I think Quinton has made this point before as well, how many people do you know that can put 2 sentences together about mining? It's very, very, not too long ago, we would talk to prospects and investors, and the biggest question that was asked about mining was, do you think Bitcoin is going to replace gold and all these things? And look, I'm not here to bash on Bitcoin or anything like that, but do people understand the relevance of mining in society at all? And the fact that we're seeing this total change of labor interest in regards to willingness to work in this industry. Are we about, this is a scary world. Like, when we talk about finding experts and people to work and operate mines, that's becoming more and more a very, a very shortage amount of folks that are available to and willing to take that type of work in today's environment. And I suspect that that's going to have to change as well. You can notice here that those long-term trends of the mining labor force it goes through trends as well. Right now we're out of favor, but at some point it comes back. After, and it's usually after. There's no better marketing than making money, unfortunately. And it's usually after the fact. This is the MBA dilemma that Peter Thiel often talks about, and it's usually the new MBA, or I should say the new thing that is popular on universities is usually in a bubble environment. And so you can take that approach to the other side of this, and things that are extremely unpopular are probably, and sometimes mining has been seen as even as uninvestable for many people that say that they are just drunken sailors in terms of spending and deployment of capital decisions that are very poor. And they're not wrong about these issues. Those are real problems from an executive and management standpoint. But again, there is a moment where you stop thinking about value and you start thinking about necessity. And I think we're entering a world where those discussions are starting now. Let's go to the next chart. Now, the next chart is just a way of measuring these things. I mean, a lot of people, like in the technology world and markets nowadays, really like Apple. Apple is about 2 times the entire energy sector in this S&P 500. Now, keep in mind that when you say this to people, they say, well, but Apple makes more money. No, it doesn't. An energy sector makes the same amount of money that Apple does in free cash flow. And I'll tell you more about this. Apple's revenues have been flat for the last 3 years. That's shocking as well. So there hasn't been much of innovation to justify the multiples and the valuation of Apple, in my view. But again, that's not specifically on one company. I'm just trying to use Apple as a great example of the overall market. You could do this with Microsoft. You could do this with even Tesla as well and other companies. But the point being, when you extrapolate that even further and look at relative to the mining industry, Now you're talking about 11 times an entire metals and mining industry. Apple is about 11 times the size of the overall industry. So, I think things are, very extreme right now and unlikely to be this in the next 5 to 10 years, in my view. Let's go to the next chart. Now, in the next chart, I'm showing another thing that people say, the same folks that used to tell me specifically. I remember you. They used to tell me, that gold would never do well. That gold is something of the past, and you're supposed to be looking at new assets and so forth. And the same people that also dismissed miners, and now miners, seniors are doing very well, are the same people that are now telling me that juniors and exploration stocks are dead. And I don't believe in that. I don't believe in that at all, because I believe in history. I believe in analysis. I don't believe in new theses that are not supported by real evidence of things. And what I find here is that the gold miners' free cash flow tends to have a very strong correlation with exploration stocks. And that's usually because as they start building more cash, you also tend to see these companies engage in M&A. And so it makes sense. They make more money. They need to grow. You have that pressure from shareholders. You got you speak with folks in the industry, and they're still talking about large dividends and buybacks. And this conversation is going to change. Wake me up when all these mining companies stop paying dividends and actually start focusing on acquisitions. That's yet to come. And most of the acquisitions we've seen are happening across the big companies. It's very likely that we'll probably see the big companies starting to buy the smaller companies because they're cheaper, because they have better valuations, because they're also securing large deposits in some cases. And they are the ones that really answer the question that their shareholders could be concerned very soon, which is growth. And we know for a fact that a lot of the mining companies have been depleting their reserves and not improving their, not really improving the quality of their assets either. So that's a question to come, in my view, and not something that has structurally changed like most people tend to propose as an idea. It's just my 2 cents. Maybe they're right. I don't think this time is different. I'm a believer of history, and I also like to support that view by looking at evidence on the data as well. So here you see free cash flow surging recently, and you see exploration stocks is still lagging. And in my view, the lag is your friend. Let's go to the next chart. In the next chart, I'm looking at a relationship that I've noticed in the past. And now we're seeing this big divergence, which I think it's a very attractive opportunity in my view. And that's gold adjusted by inflation in yellow. And then you can see the blue line is silver alone. Okay, so inflation, let's get the elephant out of the room here, which is inflation I'm calling CPI. I know a lot of people are going to hate me for this. It's just an easier name. If I say CPI, a lot of people don't, some folks don't even know what CPI is. I'm trying to simplify the chart. But you can see the idea here, though, that gold usually kind of follows, when adjusted by CPI, follows silver remarkably close. And if you see the separation recently between those two, it kind of gives you the idea that maybe the blue line has a lot to catch up on. And I suspect that we're getting very close to something very special on the silver side. Some people say, "Oh, you've been saying this for so long," and blah blah blah. Look, I'm a value investor at heart. If the thesis remains intact and the asset remains attractive, and prices won't bother me at all. We've engineered this whole acquisition of what it is now the 4th largest silver mine in the world, St. Cristobal. We did a leverage buyout with our clients and also partners of Crescat, and this has been one outstanding investment. And I think there's many opportunities in that front that provide that leverage to silver prices, of which I believe so much on the macro thesis for. So anyways, it's just a point to show how things can change very quickly on the blue line. Let's go to the next chart. On the next chart, we're looking at a relationship that often people don't talk about. The gold miners actually have a strong correlation with Japanese yen. If you notice that, well, that's remarkable. And that's usually because the Japanese yen and gold miners, what do they have in common? Well, it's the dollar cycle. The dollar cycle is usually aligned with the gold cycle. And that doesn't mean the dollar is going to lose its reserve currency status or anything along those lines. All I'm trying to say is that clearly when the miners have turned, you tend to see then a little bit of a delay, and then the yen tends to catch up to the yellow line. Notice what happened in the mid-2000s there. Mid-2000s, you can see clearly in this chart that gold miners in yellow were rising, and the blue line was not rising. It was actually diverging negatively and falling. And then we went on from, I think, 07 or 08, all the way down to 2011 or so, and one of the most aggressive appreciations for the Japanese yen versus the dollar that we've seen in history. I think we are likely to see something similar. Therefore, why I believe that I'm bullish other currencies. This is not a pick on yen specifically. It's a pick on other currencies relative to the dollar. I believe that we're about to see a big appreciation of those relative to the dollar in a large way. And I think the dollar cycle is turning. Let's go to the next chart. Why is the dollar cycle going to turn? Well, you can see in this chart, to me, is very clear. It goes back all the way to the 70s. We've seen a few of those in the past. And I think we're in the process of seeing another one. If you notice in this chart, not the very peak of the last, of that, but a little bit after that, you can see that it was really August of 2024 when on a 10-year rolling change basis, the DXY index has started to fall. And once we get into that, I mean, we haven't even seen that turn negative. Once that turns negative, we tend to see almost like a full decade of that declining. So the dollar cycles tend to be very long-term oriented. And I believe that's, we just entered another one, about a year ago. And I think this is at the very early stages of that. If you recall, wrote many letters about this. We wrote many letters about the bear case of the US dollar. I think that's just the beginning. I don't think that's the end of it. So, it's something to pay attention to. Now, remember, dollar cycles are usually linked to gold, and there's a reason why dollar cycles are usually linked to emerging markets as well, and other currencies and other markets that are outside of the US. The main reason for that is because for the dollar to depreciate, usually you have two things happening. You have interest rate differentials changing. So in other words, today, the US economy is paying somewhere close to 4 to 5% of interest payments relative to GDP. Moody's came in and said, well, we're going to downgrade the US sovereignty and so forth. And everybody knows this. And they're not wrong. What they are saying is that if you look at all the comparative economies in the world that are similar to the size of the US, nobody is paying anywhere close to what the US is paying in terms of interest payments to GDP. Japan, for instance, is paying 0.9% or something. Europe, a few countries are close to it. The majority of them are way below 1 or 2%. So the U.S. is in a position where it has to cut rates almost, or otherwise, and as we know in markets, FX is a relative game. It's not about the U.S., you having a view about the U.S. cutting rates. You have to have a view about what's going to happen in the other side of the world as well. And in my opinion, given this sense of urgency from the U.S. economy to cut rates, it's been of my view that change of interest rate differential is likely to have an impact on the dollar turn. And when you think about this, and you have the two factors that are most important in the market to think about when you're investing in emerging markets, is usually a strong dollar, and a rising interest rate environment is a no-go. You don't want to invest in emerging markets in those environments. I believe we're going to see an environment where rates might be suppressed and the dollar may actually be in a downward trend. Well, that's a green light for emerging markets in my book. So these are just the way I'm, thinking about these things. But this chart is, to me, a great way of presenting that case in terms of the turning point of the dollar, of which was maybe 8-9 months ago. But remember, once we turn negative, it's just the beginning. There's still, most likely another decade or 5 to 10 years of a very significant declines on the 10-year rolling change. Let's go to the next chart. I'm almost done. Canadian dollar is a great example. I think Paul Tudor Jones said once, a lot of people like to look for breakouts and say, whoa, breakout, now I'm going to, start investing in this asset. But what he said is that the real money is made when you are part of the breakout. And I look at this chart, and if there is a breakout, everyone would be saying, well, that was obvious. Yeah, nobody is seeing this as obvious now. In fact, we went to a presentation not too long ago in Switzerland. I was participating in a conference, and there was a panel discussion, and maybe 300 people sitting there in this event. And I asked the question, how many people, raise your hand, how many people think that the Canadian dollar will rally against the US dollar in the next 12 months? Do you know how many people raised their hand? None. Actually, I should say the guy on my side, which was Ronnie Sterfole from Increment and AG, because we were talking about this before, and we were just sharing ideas. I thought that was shocking. That was really shocking to me, because obviously I had a view about the Canadian dollar, and I just wanted to sense a little bit of the sentiment. And Canadian dollar is having a great year to date. If you look at this chart, it's a very long-term chart. So this little small appreciation that we've had recently is already there in this year. But I think it's just the beginning. I think we're going to see a lot more of that. And that's because if you want to fix the trade balance issue, you don't fix the trade balance issue with a strong dollar. I've never seen that happen before. So again, I'm using history on my side on this, and this is why what gives me conviction. And by no means I have a crystal ball on this. I'm just sharing you my views. Let's go to the next chart. Next chart is something that, if you show the white line, I've done this many times, so you're welcome to learn from my mistakes. And if you look at the white line in this chart, which is commodities to equity ratio, and you go, create a Twitter or X account and post this chart, you know what people are going to tell you? Yeah, you could have posted this 10 years ago and the chart would have been in the same place. Do you know what's different this time here? Or I shouldn't say that, because it's not different this time. The chart clearly has a cycle that changes over history. But you know what's different about the prior times you could have posted this chart is that the dollar is turning. And the dollar turning, as you can see, which is the blue line in this chart, is usually what it almost perfectly times the rise in the white line, of which is when hard assets begin to outperform financial assets. That's what this chart is about, is gold, energy commodities, is silver, metals, copper, all those things really outperforming the market, the equity market, the S&P 500, NASDAQ, the technology stocks. And I think that, more and more, if you notice on your days, today, again, being one example, of course, you can see today, again, that you have overall markets down, hard assets are rallying. And guess what's the third thing happening? US dollar is falling as well. And I don't think these things are a fluke. I think these things are happening more and more for a reason. And I think we're going to see more of that, not less, because of this chart. I think that these two lines are about to converge just like they've done it in the past. And so this is why I'm paying close attention to this. Let's go to the next chart now, if you don't mind. And this chart, now you're looking at something that, some folks have realized that I'm in an empty shelf behind me. And well, that I moved, I moved part of the year, not entire year. Part of the year, I intend to live in Brazil. And that's because I just had to move here a week ago. And so a week and a half ago. And, the reason for it is because, one, I believe in the country. I think the country is going to do great. I think that we're going to see big political changes ahead. I think things are really cheap. It's one of the few markets that I know where real estate is down over 55%. I like something cheap. And so it caught my attention. Obviously, I have family here, so it's a lot easier for me to make a change. But also, I think that the leadership in markets it changes over history. Clearly, as you can see in this chart that is on the screen, in some periods you have U.S. equities outperforming Latin America stocks. Some others you have the other way around. And we've been through the longest period in history, probably, that U.S. equities have outperformed Latin American equities. And so I'm of the belief we're going to see the opposite in the next 10 years. And so usually that tends to have an impact in the economy. That tends to have an impact in equity markets in those domestic economies. And I think Latin America is likely to be one of the best regions to invest in the next 10 years. And so this is my case for it in 2 minutes. I think this is my last chart. Just want to prove that, if that's all right. Oh, no, I have one more. This chart is interesting as well. If you notice in this chart, you take a close look, you're going to find a few things. Number one, less than 1% of people are investing in commodities. Well, that's a little bit shocking given all I said about energy, electricity, consumption potentially could surge, who knows? I don't think that justifies a 1% allocation in my strategic way of thinking of how to invest. Number two, you notice that gold and precious metals are 2% of their holdings. And that to me is also shocking. And thirdly, is emerging markets is about 1%. So I don't know, folks. I personally, I think that is, I find it actually interesting. They call this strategic asset allocation. The word strategic to me it couldn't be less of an strategic thinking than this. But I think this is the sort of the function of where capital has found itself in the last 10 years, and people tend to think and extrapolate that these things will keep going in the following decade. And usually leadership changes and asset performances changes as well over time, and you have to continue to be innovating your views about things. And I think that people are stuck in the last 10 years in these types of allocations. But that's just my view, and I believe that a lot of other things will be different in this following decade. Let's go to the next chart because I think that's it. No, that's one more thinking, because I did have questions about one from folks asking me about the 30-year yield in Japan has been moving higher, and I've people asking me what is your views on that. And look, I'm just going to share this because I think I have a unique perspective on this, and that's just because I think there's a lot of negotiations happening between U.S. and Japan right now. And if you look at the ownership of the JGBs, about 50% is owned by the Bank of Japan. And so who is selling this is a big question, right? Obviously, it's, or maybe not obviously. I mean, it's a much smaller group, who knows? And for the BOJ to step in and start buying assets again, it's not a huge ask, right? I mean, they've done it in the past, they can do it again. To me, it seems like this is almost like they're letting that happen. And the main reason for it is because, when you look at the duration of the debt in Japan, mostly is 10-year below. And so in fact, the average duration of the debt is about 9 years. And so when you think about this from a practical standpoint, the 30-year yield rising, it doesn't have a direct impact necessarily on ballooning the debt even further. And so, the real concern to me is not even the Japanese yield rise. It really is the U.S. The fact that the entire curve has moved a lot higher, and we're now seeing rates in the U.S. higher than even when Janet Yellen was the Treasury Secretary, and Biden was in administration, which is crazy. And what we're seeing here in terms of that front is to me, that's a real threat, because the U.S. doesn't have the luxury at all to let rates move to this degree. If I had a gun in my hand to choose who is closer to getting some sort of yield curve control mechanism to control or manipulate the interest rates, I think the U.S. is closer than Japan. So a few things. The dollar carry trade, the reversal dollar carry trade idea is very possible, and it's that's rising. And I feel like part of this negotiation, by allowing Japan to let the 30-year and the 10-year actually rise, would make Japanese yen a lot more attractive and Japanese assets more attractive as well, and creating a rally on the Japanese yen alone relative to the dollar, of which fixes a lot of issues. If you think about the U.S. and Japan have, a pretty significant surplus, of which Japan is running a surplus on the trade balance. And how do you fix that? Well, one way to fix that is, you fix your auto industry in the U.S., because that's a huge part of what we import from Japan. Number two, you can also improve the dollar situation. You devalue the dollar, You allow the Japanese yen to be stronger. And how do you do that? Well, you change the interest rate differential. You allow the interest rates in Japan to rise relative to US. So when people ask me what's more relevant here, I actually think it's that the US has to follow Japan and start doing more yield curve control that they did not too long ago, and they're probably going to have to do it. And this chart that you're looking at the screen goes to show that we have not seen any of that yet. I mean, just look at the BOJ, assets relative to GDP today are over 124%, and the Fed is about 22%. So I think that's very likely to change in the U.S. front, and we're probably going to see much higher levels there. I think this is my last chart, Nathaniel, if you could confirm. If you're not changing, that means I'm done. So thanks, everybody, for watching. Now we're going to play Quinton's side of the presentation, but thank you.
G'day. We're doing this via a recording once again. Seems like this is becoming more common lately, but that's the way I've had to do things. Been pretty darn busy. The mining industry is picking up. Things are looking really positive in many, many different arenas. Finance is starting to show up. Interest in investing in junior stocks is starting to increase. Liquidity is increasing. Volume is increasing. Everything's showing the signs of a resounding element of life, which is good. I think we got good times ahead of us. But this week I have a number of updates that I absolutely must get to. It's not going to be as long as normal. I think Tavi is probably given the biggest pitch today, and he's done just a remarkable job. I think the last letter that he wrote, which was I think a week or two ago, was absolutely fantastic. I don't think I've ever seen anybody write something so comprehensive about the mining industry and the needs for things like government attention and making things move forward. So kudos to him. If anything, the guy should be working with the U.S. government making mining great again. This week, Snowline, or I believe it was in the past 7 days or so, Snowline put out their new MRE. So this is the mineral resource estimate for the Valley deposit. It never ceases to amaze me how you can drill for 2 or 3 years like this and then distill all of that work, all of that hard labor, all that hard work down into a very concise mineral resource like this. But, and basically in the 2 lines that you see under that first bullet, so the 2 sub bullets, you can see measured and indicated mineral resources, 204 million tons at 1.21 gram per ton. So basically you have a huge whopping volume of measured and indicated, which means, at a very advanced level for a project like this. So nearly 8 million ounces measured and indicated. That's a 96% increase over the previous resource. That's phenomenal. So the drilling they did last season, 2024, really did bolster that the quality of these resources. Inferred, nothing too shabby there either. They've got nearly 0.9 million ounces, a little less than 1 million ounces in inferred. So 45 million tons at 0.62 gram per ton gold. Again, very good numbers. I mean, we're basically talking about, let's see, I added them up, 8.83 million ounces. Okay, now if you stop and let that sink in for a minute, that's one of the biggest gold deposits in the hands, or it's probably the biggest gold deposit in the hands of a junior mining company of this type anywhere in North America, certainly. All right, so this is kind of the top, highest priority, I'm sure, for acquisition. The top, prospective acquisition in the mining space, in the gold mining space. And to put that into perspective a little bit, look, right now, gold, I did these numbers a couple hours ago. This is, by the way, this is Thursday. So this is a day earlier than the broadcast. So if for some reason there's news that comes out on Friday morning, by the way, and I don't have it in here, it's because I can't do future news. Okay, so we'll catch it on the next go. But anyway, I took the number of ounces they have here, 8.83 million ounces, and I multiplied it by the current gold price, and you get $29.1 billion. Okay. Yeah. That's the value of metal in the ground. I mean, it's a bit of a hypothetical number because it's not really mined or anything yet. And there's no economics put to this deposit yet, but that's a lot of metal in the ground, $29 billion of metal that have been found. And let's go to the next slide. Here you can see the table. I rambled off the numbers earlier. Nearly 8 million ounces, again, measured and indicated. That's fantastic. That means they can actually, quite frankly, they could take the measured and indicated all the way through PFS or BFS if they wanted to. That's a pretty high confidence category that can allow one to advance to a PFS or BFS if the company so wish. All right, let's go to the next slide. And then here you can see real interesting sensitivity to cutoff. These are various cutoffs of grade for gold. And over here on the left-hand side, you can see it's 0.6, 0.5, 0.4, 0.3 is the cutoff they used. 0.2 is the lowest on this table. Now, what's really interesting is the differential that you see, like going from 0.3 down to 0.2, does that really add that many ounces? No, it really. It goes from 7.94 measured and indicated to 8.1. So a little bit. What is that? 0.16, so 160,000 ounces. Nothing to sneeze at, but it's nothing to write home about either. All right. So, but the point is, there's not a lot of movement. In other words, there's a fairly crisp, probably boundary around the resource that they have within the pit right now, which is interesting. Same as you move up the table too. Even if you go from 0.3 gram up to 0.6 gram, okay, yeah, you're going from 7.94 measured and indicated to 7.09. Yeah, so that you're losing about 800,000 ounces and change, but that's not a big move. Okay, like in terms of cutoff, you're not losing much gold. Okay, so again, it kind of testifies to the fairly crisp nature. Even though this is a big bowl of soup, so to speak, the bowl has a clear margin to it, and it doesn't change that much with the grade and the cutoff grade. Go to the next slide, please. Here's an image looking down at all the drilling they've done to date. You can see that they've done a pretty systematic grid approach drill program over the entire deposit, but there are areas that are still open. You can readily see several areas where there's kind of grade trying to squeak out and not closed off. In particular, I think this hole over here in the northeast, it's nothing, huge numbers, but you can see there's a hole way over there in the margin. I think that's at hole 115, if I remember right. And it had a very long run of something like 0.5 gram gold, and it's wide open to the east. And don't forget, like Racy is over there to the east. So maybe there's part of the system trying to reach out and find something else over in that direction. Never know. Sometimes a deposit you think is completely drilled off. The next thing you know, you're finding the next one and the next. So interesting picture that's unfolded here, but I do think they've done a fantastic job very systematically drilling this thing. Let's go to the next slide. Here you can see a profile of the pit. What a wonderful configuration for a deposit. The pink is the highest grade. It's over 2 grams. The red, 1 to 2 grams. Yellows are 0.3 to 1. So the 0.3 again is cut off. So basically gray is below that. There's a fairly crisp boundary to that, but it's also cohesive. You don't see, you see a nice big, cohesive blob of high grade in there with a fairly, cohesive blob of lower grade around it, and then a sharp margin, which is kind of ideal for mining, to be frank. Like it's easier for grade control. It's easier for, scheduling a mine and so forth. Very, very nice deposit to work with. You can see that the pit now does pull down and grab some higher grade cherries towards the bottom there, which is kind of interesting. We'll show you an image of what the resource last year looked like, and this is an improvement. Okay, let's go to the next slide. This is a long section, so this is basically going along the axis of the deposit. It's kind of oriented a bit to the northwest southeast, and this section goes in that direction. Again, look at the high grade at surface there, or right under grassroots. Unbelievable. Very nice cohesive blob of higher grade mineralization. one of the things that, my brain goes to immediately when I see a deposit like this is that the first few years of mining, they're probably going to dive right into that high grade, and this thing should absolutely crank out gold production. And, what that means is a lot of revenue, a lot of sales, quick, potentially quick payback, et cetera, et cetera, et cetera. Like, these are all good things, good problems to have. So this is just almost a textbook example of what you want to find in terms of a gold discovery. There is gold below that pit still. Okay, don't forget. Now, is it high grade? No, but look at deposits like Fort Knox. They've been mining Fort Knox for, about 30 years now, I think. And they're at Fort Knox. They're moving out and actually grabbing a lot of those low grade halos around that deposit. So, 10 years from now, 20 years from now, we could actually be talking about how this thing's growing even further mine life. Let's go to the next slide. This is the image I was talking about, looking at kind of a before and after picture. So if you look at the image on the left, you can see the green pit, which is the initial resource, which is, I think, May of 24, if I remember right. And then the blue one is the one that's just come out now. Okay, that's the today resource. Now, there's two things I would draw your attention to. Firstly, the block size, the granularity of the one on the left is much more pixelated. In other words, it's less defined. So a lot more inferred resources and things like that is kind of part of what's driving that pixelation. Now we have more drilling, which has better defined this and moved a lot of that to measured and indicated. Today, you can see they're using a more refined block model or sub blocks, and it produces a very, very crisp model over here on the right-hand side. It also encompasses more mineralization. The pit goes down quite a bit further. They went down, they grabbed that what's clearly a high-grade cherry towards the bottom there. All right, so that's an example of how a deposit gets refined by drilling. I think that's just a textbook example. Think of other stories that we have, like El Oro. Okay, El Oro is kind of at the left-hand side right now, but as they do more infill, they'll move more towards the right-hand side. Okay, they get more clarity, more confidence around the grade, the numbers they have, and you get a very, very crisp picture like this. Let's go to the next slide. Now we're going to move to other companies. All right, Barksdale. Firstly, I am a director of disclosure there. Look, one of the biggest goals that the company has had, really since its deal with Regal, which is Regal Resources USA, which is the underlying owner of the Sunnyside project and some of the other ground there, is to basically complete the first stage of the earn-in to get to 51%. And at this point, the drilling, the 25,000 feet of drilling, as well as $6 million defined expenditures have been met. Okay, so we have basically reached the point where we have completed the necessary requirements to get to that 51%. Okay, this is a process. Of course, there's always audits and stuff between the companies and to make sure that everything's tickety-boo. But in our view, we've resoundingly reached that trigger point, and now we're at a point where we've got to look at the next step, which is moving to the 67.5%. Okay, to get to there, we have more additional, expenditures, another 6. You can see down there in 1, 2, 3, third paragraph, and we also have to complete additional drilling. Okay, another round of drilling to go with that. I think this is an important milestone because it basically gives us a majority control over the property, and it really lets us drive the bus. In essence, we're focused like a laser on turning this thing around and crystallizing that value, but also setting a course of how we're going to advance the project from here. All right. Don't forget, this is Hermosa District. The Taylor deposit, which is one of the biggest development projects in the United States right now, belongs to South 32, is being built right next door to us. There's a likely, compelling geologic story about why the mineralization at Taylor and even the Peak deposit, which is also part of South 32's ground, will project onto our ground because we think we have the porphyry, the driver of the system, appears to be located within our property, the Sunnyside project. And we think we have not only the down dip or the continuation of those two important deposits that S32 is developing, but we also think we have the porphyry that's actually the causative intrusive for the system. Okay, so we're playing in a district where there is tremendous value. I think when South 32 bought Arizona Mining, Arizona Mining, I think it was something around 1.5 or $6 billion US value. That's the kind of values we're talking about here. And the build for the mine is something like $2 billion. Okay, this or a bit over 2 billion, I think, to put in the mine. So this is not this is home run kind of country. Yeah, the stock's undervalued. We're at 51%. You guys can figure it out. Let's go to the next slide. Little comment about the plans going forward. Look, one of the things we've recognized doing the drilling that we've done here recently is there is a near surface porphyry system, porphyry copper system. And we've seen that as a, there's the chalcopyrite, which is what we call hypogene at depth, but there's this chalcocite blanket, which could be supergene, basically an enrichment of copper in a shallower environment that we've now seen again and again and again in drill holes. Don't have our assays yet from the recent drilling that we completed, but I'm actually quite intrigued by the prospect that there could be a very large body of rock here, right in the middle of Arizona, copper country, that is associated with the Sunnyside porphyry. So, this is a story that's a little different than the Taylor Hermosa typical story, but it is very intriguing in its own right. So we are looking at this harder and harder. It could be, it will likely become the focus for our additional drilling to increase percentage ownership. That's the comment you see down there at the bottom. Okay, so stay tuned. All right, let's go to the next slide. And this simply shows an outline of the deposits. Taylor is in purple. The Peak copper deposit, Peak, which is a very early or recent discovery that's now expanding. I think Peak will grow and grow and grow over time. They're just to the east of the Sunnyside property, and they project the geology of those deposits is such that it projects northwestward onto our ground. The Sunnyside porphyry itself is located approximately where that little inset box is, somewhere towards the west side of that. That's about the epicenter of that porphyry. So we're basically playing in we'll call it a heat engine of the whole Hermosa system here. All right, let's go to the next slide. Hannan Metals. This is a story I've really grown fond of here recently because of the grassroots nature of their discovery, but also the scale of the systems here. This Valiente copper gold project in Peru. It's kind of the east side of the Andes. It's an unusual area because it's as you come off the Andes to the east, you get into the more forested jungle type area. And this area really hasn't seen historic mining. It's a lot of ground cover, a lot of vegetation and stuff. So the traditional miners never got into this country and actually did much. But these guys have done a fantastic job through grassroots work identifying these absolutely remarkable targets. And at this Bellin target, which is where they're starting to drill right now, this is the news release announcing that they've commenced their drill program. They have found multiple likely porphyry copper gold centers that they're testing for the very first time. These have never seen a drill hole. They've been found through pure grassroots efforts by the company. And we're going to find out if any of them, constitute an economic discovery of some sort. Now, Provisto. Okay, the Provisto target is also in this Valiente property. It's a ways from Bellin. It's tens of kilometers. It's a big property. So it's a ways away, and it's got a different flavor. It's really what we call an alkaline gold system. It looks like a system that's related to these very potassium and sodium rich magmas. And the alkaline gold deposits that we have around the world, they can be very, very large. Okay. And the discovery at Provisto is like aerial extent is huge. It's, probably 4 or 5 kilometers in diameter. It's a very, very large footprint of anomalous gold mineralization expressed in soils and now trenching and some other sampling they've done, rock chips and stuff. Very intriguing target. Now, it's not going to be what's drilled right now. That's going to be drilled later. They are working to get their permits, but I think the fact that they've been able to get this permit for Bellin and that they're drilling here shows you that they can get the work done. Okay, this is a really good sign. Am I as hopeful about Bellin as I am Provisto? Bellin's quite interesting. It's interesting because it's new, basically big undefined anomalies. I would love to see the company find just some major copper gold porphyries. Maybe they will, but I'm really excited about this Provisto target. I'll be frank, that one has got me super excited just because I'm partial to alkaline gold systems, as most people know. I love systems like Cripple Creek in Colorado. They're just immense gold systems, and I think these guys might have one. So both are exciting, but I'm a gold guy primarily. Anyway, let's go to the next slide. Now we're going to move to, this actually shows you the map. So the yellow is the tenement. That's the Valiente land package. And then the target. So Bellin is where the drilling, that's in the south. And then Provisto is up in the north. Quite a distance. You can see the scale bar down there in the lower left. That's 50 kilometers. So we're talking about probably 20, 25 kilometers to the north. Drilling at Bellin, going to drill at Provisto. Be patient. This is a company that's going to find something, in my view. Let's go to the next slide. Okay, Harvest Gold. This is a group that's picked up ground. They had to go at a property in BC about 3 or 4 years ago, I think. Didn't work out. They drilled, didn't hit. Okay, they moved on, and they established themselves in Quebec. They've got several properties across this area near Windfall. But they've been working at this Mousseau property primarily. Okay, now let's go to the next slide, and I'll show you where this is at. Up there in the north top of the image, you can see the greenstone belt through there. This is the urban berry belt. Okay, this is a major greenstone belt in the Superior Province, and to date, most of the work on this belt has been done in the center of that image, around Windfall, Berry, what is it? The other one, Gladiator, I believe it's called. Anyway, Windfall, of course, was advanced and by 03 or whatever, and was sold to Goldfields. So that is a huge deposit. Again, one of the biggest gold deposits now. Now it's not in the hands of a junior; it's actually in the hands of a major. But it was probably the last cab on the rank, so to speak, prior to Snowline. It's now been sold to Goldfields. They control it 100%. Big success, big exploration success, right in the middle of that greenstone belt. Well, you come over here to where Harvest is located on the left-hand side. You can see they've got two major belts of tenements that cover what I think is kind of like the mirror image of that greenstone. Okay, so this Mousseau property in particular kind of reminds me of what we see over there at the more classical Windfall Berry region. Now, this area that they have has very little exploration. There are historic references to gold occurrences. Those are the little diamonds that you see scattered across that map in the lower right there. But what the company has done recently is put in a soil grid. So they put in those little polka dots to evaluate the soil, the gold in soils, to identify new targets. All right, so go to the next slide. We're going to look at what they've turned up. This is a zoom in of that grid. Basically, anything that's in red is in the 98th percentile. So the top 2% of all the samples in the grid are expressed in red, and then the top 5%, so the 95th percentile, are in the yellow polka dots across there. All right, and it gives you a sense that they have found in a brand new area, absolutely brand new area. They have found gold that has never been recognized, other maybe historic prospecting, where you see the little little yellow stars. This is gold that really hasn't been recognized by historic work. All right, so these are brand new targets. This is how you make discovery. Now the background there is magnetics, and clearly you can see that they can see a pattern with the ice direction, which is moving from northeast to southwest, where it crosses this, we'll call it magnetic fabric. It has apparently pushed in linear fashion gold anomalism into the soils, to the southwest from these various magnetic features. Does that mean there's discovery there? Don't know yet. But this is really intriguing. These are nice drill targets that could be drilled here in the next few months. Good on them. Let's go to the next slide. Okay, Mogotes. This story gets me even more excited. I think I talked about this on the last video we did 2 weeks ago. They had identified immediately south of the Filo property. They had identified a new target at Mogotes, and now they've come back more recently with some geophysics that support it even more, support the presence of a very large system on their property. Let's go to the next slide. I'll show you where this is. First of all, that greenish trend with all of the bright colors there, that is basically the Filo del Sol drill array. The Aurora deposit is that tightest cluster of drill holes right in the center. That's where the core of that is. By the way, they did announce a resource for that, absolutely phenomenal size and grade. It's one of the biggest discoveries of copper gold in modern history. And don't forget, this was an acquisition here recently. BHP and Lundin teamed up to buy this, and they paid $4.6 billion. So it shows you the value that was created through the discovery of this massive copper gold system there at Aurora. But that trend continues southward, and it projects onto the Mogotes ground at Filo Sur. And this area, this Los Mogotes, sorry, this is the new target. Los Mogotes is what they call it, and it's just south of Mesita, which is right on the boundary. You can see in faint gray there, you can see the name. That has turned out to be a whopper of an MT anomaly. MT is an electromagnetic geophysical technique that basically looks at how resistive rock is, or resistive versus conductive it is. And there is a whopper MT anomaly I'm going to show you. You can see the bright colors there, the reds and purples. Doesn't really tell you what's going on just looking at it in plan view. Let's look at it in section. Go to the next slide. Okay, this is a beautiful diagram. I mean, this is one of the most compelling, wow, kind of stories you can see in terms of targeting out there. What are we looking at? We're looking at a long section. This is a cross section that goes down the axis from north to south from the Filo del Sol property, all right, all the way down through Mogotes Metals into the Los Mogotes target and this geophysics. So you can see all the drill holes on the right there. That defines the various deposits. Yes, Aurora is just one of several. Sorry, I don't mean to make it sound like Aurora is the only thing, but you can see the deposits there. I think Aurora is the kind of the heartbeat of the whole thing. It's the critical mass of the system. And you can see a little arrow there. It points up. There's a drill hole not too far north of the property boundary that hit 610 meters of nearly 0.4 gram gold and 0.15% copper. So there's clearly mineralization almost to the property boundary. But look at the target they have. This MT anomaly is a whopper. Okay, this is a pretty big scale look at this thing, but it's a vertical anomaly. That excites me because porphyries usually form pipe-like bodies, and that has the shape that I would expect for a porphyry. It's got a nice halo around it with the kind of bunny ear things poking off, probably an expression of diffuse pyrite going out into the rock adjacent. Basically what you're looking at is going from relatively low resistivity rock, the purple, to higher resistivity rock as you go outwards. And that's the exact kind of pattern I'd want to see here. And to me, that's just a beautiful, beautiful porphyry target. Okay, so not only do we have the geochem that they showed in the news release a few weeks ago, now we have the geophysics to back it up. And that looks like a target that could easily reach from surface. Look at the depth of drill holes over here on the right. You can easily see it. You can drill over there and reach that target, no problem. Let's go to the next slide. Okay, so this is a closer view of that. Okay, so the image over here on the right is basically a zoom in on that area at Los Mogotes target. You can see in faint colors there, the purple and red, Pajinga sticking up, the pipe-like thing, and then the bunny ear things sticking off the sides. Notice that at surface, they've mapped and they see alteration. So the rock has been cooked up, it's been flooded with fluids and cooked into various stews of clay and whatnot. And those patterns that they see mimic what they see in the subsurface. In other words, over here where they say phyllic and paragonite, look, that is telling us likely a higher temperature part of the system. And lo and behold, that's kind of above that, that real beefy area in the MT right above the Pajinga sticking up. That's intriguing. That's really, really intriguing. It's basically like it's the ink stain, ink blot on, you spill ink on your shirt. It's like yep, there, drill there. Okay, so we got a really well-defined target, but it's also defined by geochemistry. They did lots of rock chip sampling. It was in that previous news release, and that whole area just lights up with copper values up into the 0.5 or 6% range. Okay, so even at surface, they're seeing good values. Imagine what they might find at the drill down. Let's hope. There's no promises in life, never a promise, but man, that looks like a great target. And I'm just so hopeful these guys, which really smart team, make a discovery. What do we have on the left? That is simply a geologic model. It's a schematic model that shows a porphyry there at depth with the more epithermal part of the system above it. So we get the porphyry with a high sulfidation system over the top of it. What they're trying to say is that Mother Nature has eroded down to that dash line, and we're basically sitting in an environment just above the tippy top of the porphyry. So we stripped off most of that epithermal material, and at least in this area, and we're looking at a porphyry target now below. Now, to give you a sense of what this, this is a highly speculative property. Okay, nothing's guaranteed in life, but just to give you a sense of what a discovery like this could look like, there was an announcement this week. Go to the next slide. About a discovery over here on the blue ground that you see on the right-hand side, the NGex. Okay, now, what are we looking at here? This is the property position. North is to the right, okay? So everything's been rotated. And basically, we have Mogotes ground, which is on the left-hand side, the teal blue. BHP and Lundin is the orange ground in the middle. And we have NGex over here in the baby blue on the right-hand side. Now, this Luna Huasi discovery that you see, which is closer to the BHP side, property, that one, they had some remarkable news this week. Absolutely remarkable. That's a discrete porphyry target, similar geophysical expression, similar surficial, alteration, geochemistry, and et cetera, et cetera. That's basically similar to what we're talking about over here at Mogotes. The target we're talking about, see where it says new option claims, that yellow blob kind of immediately south of those words, that's the target we're talking about, this Los Mogotes target. So let's go to the next slide and let's look at this Luna Huasi discovery. This week, NGex announced a 1,619 meter, that's a mile. Think about it. That's a mile of mineralization. Intercept of 0.87% copper equivalent. Now, within that, there's higher grade. There's 876 meters of 1.13% copper equivalent. which is remarkable. Okay, now it's kind of hard to see the drill, but basically that thicker black line, they have several holes that were drilled previously, like, come down. They were trying to reach down to it, the thinner black lines, and they were seeing some pretty good numbers. But this hole, they went long. Okay, they said, there's something happening more beyond the end of those previous holes. Let's drill down. So this hole 27 kept going. It kept going. I think it was like 2 kilometers long in total. It was crazy. But it hit, okay? Look at how this went through. It really went through what is the high sulfidation part of the system. And yeah, there's mineralization there, but it carried on. And down there at the bottom of the drill hole, they hit, look at this, 743 meters of 0.56% copper equivalent, of which 0.44% is copper itself. And then there's 0.13 gram gold, and I think the 2.3 is silver. Yeah, silver. Okay, great intercept, but it's in proper porphyry mineralization. You see the little blue dashed lines, the potassic zone, and then you got probably the phyllic zone or something. Anyway, that is your porphyry. That kind of arcuate picture there, that is the porphyry. So imagine over in Mogotes, the big Pajingas sticking up, that's the Pajingas here. And when they drilled down and they got into the Pajingas, guess what they hit? They had a big, fat porphyry, okay? Could we find the similar thing over at Mogotes? Let's hope so. That'd be really exciting. Next slide. Okay, Newfound continues to do exploration drilling along the Appleton Fault Corridor. And they've been focused quite a bit around the area they picked up from Lab Gold a few months ago, or it's probably been a year now that they picked it up. And there's this one target called Dropkick, which is, I think, the northernmost target, or close to the northernmost target along the Appleton Fault Zone. But they've hit some nice high grade, 42.8 gram over nearly 15 meters, 47.6 grams over nearly 4 meters, 22.9 over 2.4. So, even though this is kilometers, like 8 kilometers away, they're still hitting high grade on this Appleton Fault Corridor. Anybody thinks this is a small gold system, that's crazy. Okay, how could something 8 kilometers, at least 8 kilometers long, just go down 200 meters and stop? That's nuts. Okay, that's not the way Mother Nature works. These are all part of a bigger system that penetrates down into the ground. In my view, there's a lot more gold here than has been announced in their recent resource. In my view, my strong view, but it's my view. And the fact that they're seeing high grade this far away from the Keat Zone, for example, tells you that this is a whopper of a system. Even at Fosterville, which I did a lot of work at, I don't remember seeing high grades like this far away from the mothership. So I think that's a good sign. Let's go to the next slide. This just gives you a sense of scale. So you've got, in north is rotated. Okay, so north is kind of to the upper right. The Appleton Fault Zone is a black line. All the main deposits they've worked, like Keats and Keats West and so forth, are down here in the lower left. You've traced the Appleton Fault Corridor, and you can see as they get up into the old lab ground, they've made several high-grade discoveries there. And this Dropkick Zone is that one in the upper right, so farthest north. Remarkable. Okay, yeah. Don't tell me there's not more gold here. This is a big system. All right, let's go to the next slide. Okay, Tectonic. Look, we don't talk about placements per se. That's just not our cup of tea. But what I want to point out is that the company has money to be aggressive this year. And this is May, okay? We don't have to wait until August or September or whatever to get out in the field and start working. The company has cash. They have their targets are well defined, getting back into this Alpha Bowl where they hit a very nice drill intercept last year, albeit short, but probably telling us there's a much, much bigger discovery there. Look, they have the money they need. They can get in there and get the program going, and they can drill aggressively this year. Think about the gold market where it's at. It's picking up. We're starting to see more and more steam. Let's hope this continues. No guarantees in life, but let's hope this continues. I think this company is done a complete 180, is headed on the right path. They've tightened up the share structure. They've got cash. They've got momentum support from a lot of new investors. They're going to get out in the field. They said it right here. Okay, they're going to get out and bust their rear end and try to make a big discovery this year. Maybe this is our next valley. Who knows? Let's see. Go to the next slide. Okay, Westward Gold. I'm not looking to toot my horn, but I did join Westward. I'm joined as chairman of the company. You say, Nevada Explorer, why would I focus on this? Okay, well, this property, this target is one of a target that I identified. This is in the Toyabe range in Nevada, so near the Cortez mining district that's controlled by the joint venture between Barrick and Newmont, the Nevada Gold Mines joint venture. This is very close to that, and I think this is a critical piece of that Cortez district. And I identified a target here many years ago, and this company has it, and they're about to test it, and I'm so excited. I can't stand it. I've been waiting years and years to see this. I know a lot of the technical people on their team, first class people, really smart mappers, explorers. These guys know what they're doing, and I am just riveted to be part of this story. So looking forward to that. All right, I think that's it. Go to the next slide. That might be it. Okay. All right. Well, that's it for me this week. Have a good couple of weeks. We'll see you shortly. Take care.
All right. Well, thanks, Quinton, for the presentation. Kevin, unfortunately, couldn't share his part of the presentation this week, but in 2 weeks, we'll be back with the three of us, and hopefully we'll get a full presentation to all of you. If you have the chance to read our letter in a research piece that we put out, I suggest you to do so. It's in our website. I find it fascinating the fact that we're seeing, again, hard assets outperforming financial assets, specifically equity markets. I think that's really at the core of our views. And I also find it fascinating how the other asset that is starting to join this behavior is the dollar. And the dollar, to me, is what holds the key for the entire financial sector, more even than the treasury market. Because it's the treasury market selling or buying that really causes the demand or not for the dollar as well. So the dollar is really what drives the whole thing. And if that's likely to turn, I think there's a lot of things that we need to consider. I want to point out to a chart that I had in the presentation that was gold adjusted for CPI relative to silver. And I find that chart specifically also very relevant to discussions and when thinking about allocation and also thinking about opportunities. And, silver has been a metal that at least we at Crescat have been covering for the last few years at least. And we've been looking for exposure to companies and businesses that are linked to silver prices, what we call leverage to silver prices. I.e. St. Cristobal was just one example of those companies that have exposure, but we have plenty others that have the same, and there are others in the markets as well that offer the same. But remember, leverage works both ways, in a positive way and a negative way. I think that it's prudent to understand that that's just the involvement of risk on that front as well. But very exciting in my view, what's likely ahead for companies and businesses that have large exposure to silver. And again, these are just my views on what I think the underlying metal will do in this next decade, given the supply and demand mismatch that we have in this world of metals. Lastly, if you enjoyed this video, I suggest you to follow Crescat's YouTube channel, and also you can follow us on Twitter as well. And we'd love to share more about what we do as well. If you would like to speak with Merrick, he would love to share more about Crescat as well. But with that in mind, thanks everybody for watching this video, and we'll be back in 2 weeks. Thank you again.